The more I dig into how the stock market actually works, the more I get the chills. I realized I have been lied to for a whole decade. Have you ever wondered why 95% of hardworking people still lose money? They read the charts and analyze the financial reports every single day. Yet, a tiny group of people makes money so easily that it is almost embarrassing. The truth is, this market is not built on math or economics. It is built on the betrayal of your own trust. If you do not know the secret I'm about to reveal, you are not an investor. You are just a puppet dancing to a script written by the giants. You are handing them your money with a smile on your face and you don't even know it. You are looking at a pre-designed mirage. Be honest with me. Have you ever stared at your screen and seen a perfect support line? Maybe it was a cup and handle pattern that looked like a work of art. You thought to yourself, there's no way this trade can lose. You entered the position and set your stop loss right under that bottom. And then, boom, the price drops just enough to hit your stop loss, and then it takes off like a rocket. That feeling is not bad luck. You were hunted. The cold, hard truth in 2026 is this: technical charts are not maps to a treasure chest. They are psychological traps. They are designed by the best minds in human behavior and trillion-dollar AI algorithms. Those pretty lines you see on Tradingview are not there to protect you. They are road signs that big financial institutions use to herd the crowd. They want to push everyone into one spot so they can find liquidity. Let me be blunt. If you see a buy signal that is too obvious, you are the product being sold. Why do I say this? Look at the reality of the market in 2026. Right now, over 90% of trading volume is done by advanced artificial intelligence and high-frequency trading. These algorithms do not care what a company actually does. They only care about one thing, and that is liquidity. If a massive hedge fund wants to sell $500 million worth of stock, they need a lot of buyers. If they just dump it all at once, the price crashes and they lose money. So what do? They paint a perfect technical pattern. They create a support zone that even a teenager who started trading 2 weeks ago can see. When 1 million people see that beautiful buy point and set their stop losses right below it, a giant pool of liquidity is born. The algorithms push the price down to hit those stop losses. This allows the big players to fill their sell orders at the best possible price. The data does not lie. 85% of fake breakouts today happen at classic technical patterns. You are using tools from the 1990s to fight supercomputers from the future. You are not losing because you are stupid. You are losing because you are way too predictable. Take Alex, for example. He is a typical Gen Z worker in New York who works remotely for a tech startup. Alex is smart. He uses AI tools to help him analyze the market, and he is confident he has an edge. Last month, Alex saw an electric vehicle stock forming a perfect inverted head and shoulders pattern. Every Discord channel and every finance creator on TikTok was screaming to buy the breakout. Alex put all $20,000 of his savings into it. He was disciplined and set his stop loss right under the neckline. 15 minutes after he bought in, a giant red candle appeared. It wiped out his entire account in an instant. He got a margin call and was kicked out of the game. But the very next second, the price reversed. It went up 30% in just 2 days. Alex just sat there staring at a blank screen. That head and shoulders pattern was not a reversal. It was a bucket for liquidity. The big funds created it to soak up all the money from people like Alex before they pushed the price up. Alex was right about the trend, but he was wrong about how the sharks play the game. Stop looking at the charts and start looking at the panic. How do you escape this trap? Stop being a chart person and start being a psychologist. If a pattern looks like it came straight out of a textbook, assume it is a trap. Do not enter the trade right away. Wait for the stop run to happen first. You should trade based on the failure of the crowd. Instead of buying a breakout, learn how to buy when the price breaks down but snaps back quickly. That is the sign that the big players have collected enough shares from the people who got scared. Ask yourself this question: if I were a shark and I needed $1 billion in liquidity, where would I want the crowd to put their stop losses? When you find that spot, wait there instead of standing with the crowd. Use inversion thinking. Buy when the chart looks ugly and scary. Buy in the value zones that nobody else dares to touch. That is where the smart money is working. Remember, in this market, safety is an illusion. When you feel the most safe with your chart, that is exactly when you are the most vulnerable. But the chart trap is nothing compared to the next mistake. This one is quietly draining your wallet through a concept that sounds very professional. In reality, it is a poison for your wealth. I'm talking about diversification. Let me show you why putting your eggs in many baskets is the fastest way to stay broke. It's a sedative for the lazy. Do not put all your eggs in one basket is probably the most common financial advice ever. It's also the most toxic lie of all time. It sounds mature and safe, right? But the truth is, over-diversification is a cocoon you build to hide a scary truth. You have no idea what you are doing. They tell you to split your money into 10 or 20 different stocks to lower your risk. But look at the facts. You're also lowering your chance of ever getting rich. In 2026, everything moves at the speed of light. Owning too many stocks just turns you into a mini index fund with mediocre results, and you're paying for it with your own time and effort. Diversification is not an investment strategy. It's a defensive strategy to keep you from going bankrupt. It will never help you break through. If you want to be safe, put your money in a savings account. If you want financial freedom, you have to know how to bet big on what you understand. Why does diversification not work like it used to? Look at the market today. In the age of artificial intelligence and super algorithms, the connection between different industries is at an all-time high. When the market sneezes, 90% of stocks catch a cold. Holding 15 different tech stocks does not lower your risk. It just makes your eyes hurt when they all turn red at the same time. Studies show that the benefit of lowering risk hits a wall after you own 8 stocks. From stock number 9 and beyond, you are not any safer. You are just diluting your own profits. Let us do some simple math. If you have $10,000 and you split it between 20 stocks, each one is only $500. Even if one of those stocks doubles in price, your total wealth only goes up by 5%. Is that 5% worth the hundreds of hours you spent tracking reports and news for 20 companies? You are making the stock exchanges rich with your trading fees, while your wealth goes nowhere. Over-diversification is how you buy a fake sense of security at the cost of real wealth. Let us talk about Sarah. She's 26 years old and works as a graphic designer in Austin. She's very careful with her money. Sarah is proud to being a smart investor because her portfolio has 30 different stocks. She has everything from electric vehicles to green energy and biotech. She subscribes to dozens of newsletters and has alerts for every single stock. Every day after work, Sarah spends at least 2 hours reading the news for her baskets of eggs. What was the result after 2 years? Her portfolio grew by 8% per year. That was just enough to cover inflation and her trading fees. Meanwhile, a friend of Sarah's only focused on 2 companies. He understood their supply chains perfectly. He didn't even read the daily news. He just kept buying more whenever the price dropped. After 2 years, his wealth tripled. Sarah didn't lose because she was lazy. She lost because she wasted her most valuable resource, which was her focus. She knew a little bit about everything, but she understood nothing deeply. In the world of investing, a little bit of knowledge is the #1 enemy of profit. If you want to escape this cycle of staying broke, you need to change your mindset right now. Here's your roadmap. First, trim your portfolio without mercy. Look at your current stocks. Keep the 3 companies that you can explain to a 10-year-old child in 30 seconds. What about the rest? Sell them all. Do not look back. Focus on the magic number 3. Why 3? Because 1 is too risky. But with 3, you can actually spend enough time to read every line of their financial reports. You can know who their rivals are and what their leaders are thinking. You must know them like the back of your hand. Buy understanding. Do not buy luck. Do not enter a trade because of some tip you saw online. Enter a trade because you found a competitive edge that the market is missing. Real wealth comes from being more right than the crowd on a few big deals. It does not come from being a little bit right on 100 small deals. Stop seeing stocks as jumping numbers on a screen. See yourself as a part owner of those 3 businesses. Would you worry if your shop had no customers for just 1 day? No, not if you knew its long-term value. Real wealth requires the courage to put your eggs in a few high-quality baskets and then watch those baskets like a hawk. But even if you pick 3 perfect companies, you can still lose it all. That happens if you keep filling your head with information junk every day. The crowd is being poisoned by what they call the news. I am going to show you why reading the financial papers every morning is the fastest way to make the dumbest decisions of your life. You are eating the leftovers of the giants. Stop waking up and checking your finance apps. You are consuming information trash that has already passed through thousands of hands before it hit your eyes. The biggest pain for young investors in 2026 is believing that getting news early will help them win. That is a mistake. In the world of artificial intelligence and high-frequency trading, your early means 2 weeks behind the smart money. When you see a flashy headline about a company signing a billion-dollar deal, you are not getting an opportunity. You are the one paying the bill for the party. The insiders and big funds bought in when the news was just a rumor. Now that it is on the front page, they need you to jump in and buy. This lets them take their profits and leave. You are not investing. You're picking up the crumbs that fell under their table. Why do I call the news rotten food? Look at how the market works in 2026. Right now, large language models and artificial intelligence scan financial reports and satellite data in a fraction of a second. By the time an event actually happens, the market has already digested it. The stock market does not run on news, it runs on expectations. A stock can rocket up on bad news simply because the news was not as bad as people expected. On the other hand, a stock can crash on record profits because the crowd expected even more. Data shows that over 70% of the biggest price moves in 2025 happened before the official press release. If you wait until you see breaking news on your phone, you are in a race where the finish line was moved before you even started. Mainstream news does not exist to make you rich. It exists to create the excitement or the panic that the big players need to find liquidity. Take Tyler, for example. He's a young software engineer in Silicon Valley. Tyler works hard and follows every finance channel on YouTube. On Monday morning, his phone buzzed with a headline about a breakthrough in battery technology. Tyler looked at the chart and saw the price was up 5%. He quickly put in $50,000 because he was afraid of missing out. He thought he was ahead of the curve. But what happened? Just 2 hours later, the price reversed and started to tank. It ended the day down 10%. Tyler was stunned. He could not understand why the price would drop on such good news.
The truth is, the hedge funds knew about that battery tech 3 weeks ago when it was still a secret test. They bought in at the bottom. When the news hit the papers that morning, they used Tyler's buy orders to dump their shares. Tyler did not buy an opportunity. He bought the debt of people much richer than him. You need to learn how to read the silence of the market. To stop being the person who pays the bill, you have to change how you get information. Here's the strategy used by the top 0.1% of investors. First, use the 48-hour rule. Never trade based on any news within 48 hours of it being published. Let the crowd fight it out first. When the dust settles, you will see the real trend. Watch the reaction. Do not read the content. This is the most important technique. When terrible news comes out, but the stock price does not go down, that is a golden silence. It shows that there is nobody left to sell. The people holding the stock have diamond hands. That is when you bet everything. Ignore the adjectives. When you read a story, cut out words like breakthrough or record. Only look at the raw numbers and compare them to what the market expected. The news source is trash, but the money flow is real. Do not trust what they say, trust what they do. Look at the volume. If the price goes up on low volume after good news, it is a trap. Remember, news is for entertainment. The silence of the chart after the storm is where the real money is made. Do not let the media control your heart rate. Now you know how to ignore the noise, but even with a strong mind, you will fail if you do not see the biggest trap of all. This is the deepest secret I promised you. It is a twist about impatience that 99% of people are falling for. The fear of being left behind is your #1 enemy. Let's be real for a second. What hurts more? Seeing your account drop by 10% or seeing your neighbor or some 19-year-old on TikTok show off a 10 times profit while you're playing it safe? Your biggest fear is not losing money, it's seeing others get rich faster than you. The artificial intelligence algorithms in 2026 know how to exploit this perfectly. The stock market is not a battlefield of numbers. It's a machine that transfers wealth from the pockets of those who want to get rich quick to those who are willing to wait. The truth is almost embarrassing. You do not need to be smarter than the market. You just need to be more bored than the market. The giants know you have a limit to how long you can wait. They will do everything they can to push you to that limit. This is the mechanism of psychological exhaustion. Why do 99% of people sell right before the price takeoff? It's because big funds use a tactic called time arbitrage. In 2026, supercomputers don't just analyze charts, they analyze your heart rate and your dopamine levels through social media data. When the price goes sideways for a long time, it's not because the market is weak, it's a process of herding. They are waiting until the last buyers get tired and frustrated. They want you to say to yourself, "This stock is trash, I'm moving to something faster." The moment you hit that sell button because you're bored, the liquidity hits zero. When there is nobody left to sell, it only takes a tiny bit of buying to send the price up 30%. You just did your job as a sheep. You gave your shares to the patient players at the lowest possible price. The secret is not guessing when the price will go up, it's identifying when the last seller has finally disappeared. Think back to Sarah. After she trimmed her portfolio to 3 stocks, she did great for 3 months. But then, one of her companies went into a long sideways phase. At the same time, the rest of the tech market was booming. Other stocks were going up every day. Sarah started to doubt herself. She read the forums and saw people calling her stock a zombie. Her dopamine hit rock bottom. Every morning, she felt like a fool for standing still while the world got rich.
Finally, on a gloomy Friday afternoon, Sarah sold everything. She jumped into the hottest stock of the week. Can you guess what happened? Just 48 hours later, Sarah's zombie stock announced a tiny contract. Usually, nobody would care, but because there were no sellers left, it triggered a massive rally. It went up 50% in 1 week. Sarah did not lose because her analysis was wrong. She lost because her nervous system could not handle the silence. She was crushed by the machine of impatience. You need to become the most bored person on the trading floor. To master this secret, you need to do 4 things. First, find the dead zone. Do not buy when things are exciting. Look for good stocks that have been flat or down slightly with very low volume for 6 months. That is where the sellers have given up. Second, turn off your price alerts. If you believe in your 3 businesses, looking at the screen every day only ruins your dopamine. Only set an alert for when the price hits your value zone. Third, measure the anger. When you see that 90% of people on the forums are complaining or giving up on a stock, that is your strongest buy signal. That is the point where psychological exhaustion meets the smart money. Fourth, practice the art of standing still. Ask yourself if you can hold your position while everyone else gets rich faster than you for a whole year. If the answer is no, you are still a puppet. The richest people are not the best at math, they're the ones with the least emotion. They sit still while the rest of the world goes crazy. But understanding patience is only the first step. To really close the deal, you need some dark tips to protect your profits. The herd instinct is a death sentence for your account. Your brain was not designed for the stock market. It was designed for survival in a cave. Back then, being separated from the herd meant death. That is why you feel anxious when you are not buying what everyone else is buying. But in finance, the crowd is always wrong at the turning points. To be in the top 0.1%, you must learn to feel safe when you are alone. You must feel very uneasy when everyone agrees with you. The biggest profits are always where nobody else is looking. In 2026, we have artificial intelligence tools that measure social sentiment in real time. But you don't need a supercomputer. Just look at the chat groups and the comments. When a stock is being cursed by the whole community, that's when the selling is exhausted. The weak hands have already sold. The only people left are the whales with a 10-year vision. On the flip side, watch out for extreme excitement. When your coworkers who know nothing about finance start bragging about their profits, that's a giant red flag. When the slowest people have already bought in, there's nobody left to push the price higher. The cheese in the mousetrap is about to snap shut. In the world of money, the agreement of the crowd is the kiss of death. Look at Marcus. He's a rideshare driver in Chicago. Marcus represents the new wave of investors in 2026. He doesn't read reports, he follows influencers on TikTok. In early 2025, when AI stocks were peaking, Marcus made 3 years' worth of salary in 1 month. He told all his friends to quit their jobs and invest. Marcus felt like a genius, but he was just standing on top of a wave of pure hype. Right when Marcus decided to go all in with his savings and borrowed money, the market turned. The smart money had started pulling out 2 weeks earlier. They left as soon as they heard people like Marcus bragging. While Marcus was holding on and hoping for a recovery, the stocks he called trash were quietly growing. Marcus failed because he bought the excitement of others and sold his own patience. Here are the 4 inversion steps to master the game. First, create a hate watch list.
List 5 stocks with good foundations that are being trashed online. When the negativity hits its peak, that's your golden buy zone. Second, use the relative gauge. If a relative who knows nothing about stocks asks you how to buy a specific ticker, sell it immediately. If they complain that the market is a scam and they're never playing again, start putting more money in. Third, measure your boredom threshold. Real investing is boring. It's like watching grass grow. If you feel excited while trading, you're gambling. If you feel bored and want to turn off the computer, you're on the path to wealth. Fourth, trade with the pain. Before you enter an order, ask if it makes you feel uncomfortable. Ask if it goes against everything the crowd says. If the answer is yes, you probably have a high chance of winning. Easy trades are usually the ones that wipe you out. You make money by solving the liquidity problem for people who are panicking. You keep your money by refusing to be the liquidity for people who are excited. Mastering this will protect your wealth, but it's not enough to truly break through. The next mistake is how you handle sudden wealth when your hated stocks finally explode. If you don't know how to leave without leaving a trace, you'll give all that profit back. That's why the video on the invisible exit technique is the final piece you are missing. It's waiting for you right here.